Fidus Investment Corp matched Q2 2026. Adjusted EPS estimates exactly at 50 cents a share. And they actually beat on the top line.
Right, coming in at 43.5 million.
Yeah, which is an 8.8% year-over-year jump, easily clearing the street's 42.37 million estimate. Plus, they declared a total Q3 dividend of 50 cents per share.
Maintaining that 43-cent base and the 7-cent supplemental payout.
Exactly. So you have a revenue beat and a rock-solid dividend. Yet Wall Street immediately dumped the stock.
It did, yeah.
FDUS dropped 1.74% to close around 20.22. And it did so on heavy trading. I mean, almost 3.9 times average volume.
Well, that volume is the dead giveaway. When you see a top-line beat followed by massive institutional selling, the smart money is clearly looking right past the headline revenue.
They're digging into the core earnings.
Exactly. They are dissecting the earnings power of the underlying debt, spotting the structural margin compression, and deciding the risk-reward ratio has fundamentally shifted.
So, in this deep dive, our mission for you is to unpack exactly why the stock sold off despite that revenue beat. We're going to look under the hood at their segment performance.
Because that top line only tells you how much money came in, not the quality of it.
Right. We'll look at how they manage originations in this stalled M&A environment, how margins are actually compressing, and the specific risks management is flagging.
The tail risks here are fascinating, especially with floating rates.
So let's start with how they generated that 43.5 million top line. Fidus deployed 98 million in originations this quarter.
Which is a massive number right now.
Yeah, because with geopolitical uncertainty and market volatility weighing so heavily on M&A, I mean, the market's basically frozen. Isn't 98 million in origination surprisingly aggressive?
It looks entirely contradictory, yeah. But you have to look at the specific sandbox they operate in.
The lower middle market.
Exactly. Fidus doesn't lend to mega-cap, publicly traded companies. Their entire model is built on highly fragmented private companies, usually generating between 10 million and 150 million in annual revenue.
So the portfolio expands to this fair value of 1.4 billion across 100 active companies.
And first line in debt makes up 79.1% of that fair value.
Right. They added 4 notable new ones. Pure Cars got a 21.5 million first lien. National On Demand took 15.4 million. Plus, they dropped significant capital into Acorn VMS and BPCP DCOM.
And remember, the transaction triggers down in this space are different. A founder of a 40 million company still needs to retire, right?
Yeah, life goes on.
Exactly. Private equity sponsors are still doing roll-up strategies. And because traditional commercial banks have pulled way back, credit is incredibly tight.
Which puts Fidus in the driver's seat.
It really does. They dictate these highly structured first lien terms, even when broader M&A is stalled.
And meanwhile, repayments and realizations brought in 39.2 million this quarter. So money's coming back, and they're aggressively putting it back to work.
And they're doing it at great rates. The weighted average yield on their debt investments right now is sitting at a highly attractive 12.5%.
But that yield brings us to the margins. Because originations look solid, but the market's reaction was tepid, we really need to look at what's happening to the net asset value, or NAV.
Right. NAV held relatively steady, but it did see a slight dip.
Down to 19.46 per share from 19.55 at the end of 2025.
Yeah, but to really understand the margin story, you have to look at the equity kickers. Fidus realized 6.4 million in net gains from 3 specific equity monetizations this quarter.
Midshare Holdings, USG Holdings, and Worldwide Express.
All right.
It's almost like venture capital for established businesses. They collect that steady 12.5% yield on the debt, but the real margin padding comes from these minority equity kickers when the portfolio companies are sold.
That's a perfect analogy. The debt provides the floor, it pays the bills, but the equity provides the real upside. Those realizations are crucial.
But they're also lumpy, right? They don't happen every quarter.
And that is exactly what the institutional sellers locked onto, because if you look at the sequential margins, they're compressing. Adjusted net investment income, or adjusted NII, dropped significantly.
It went from 62 cents a share in Q1 down to 50 cents in Q2.
Right. That sequential drop in core earnings power, the pure cash the debt is throwing off minus costs, is exactly why the stock traded down post-earnings.
Okay, so if margins compress sequentially, what is management actually seeing on the ground regarding the credit health of the businesses they're lending to?
Well, on the call, CEO Ed Ross explicitly stated that credit quality remains sound.
Right, they said underlying portfolio companies are showing average EBITDA growth of about 6%.
Which is strong in this environment. It shows resilience.
And crucially, at the time of the earnings call, Fidus had 0 investments on non-accrual status. Plus, they said deal flow is improving for Q4.
0 non-accruals across 100 companies.
But wait, if EBITDA is growing 6% and there are literally 0 non-accruals, isn't management painting a picture that's almost too perfect?
It does feel a bit pristine.
Right. I mean, is there a disconnect between their tone and the reality of surviving a 12.5% yield environment? It's a huge debt burden for a small company.
You're hitting on exactly what smart investors are pricing in. Look, BDC management teams always emphasize the positives.
Of course.
The 6% EBITDA growth is a real metric, but the 0 non-accrual rate is a snapshot. In the lower middle market, if a company is struggling, the private equity sponsor will often inject fresh equity from their own funds just to keep the loan performing.
To avoid wiping out their own equity stake.
Exactly. So the company might be stressed, but the sponsor writes a check. The problem is that sponsor support is finite.
So eventually the music stops.
Right. Which brings us to the hidden risks. Since the market is clearly pricing in caution despite the pristine non-accrual rate, let's look at the structural risks.
Well, the biggest one is interest rate risk. 72.4% of Fidus's debt investments are floating rate.
That is massive. If the Fed cuts rates rapidly, that 12.5% yield is going to compress mechanically.
It just automatically shrinks. And then you have actual realized losses. Right after Q2 ended, on July 31st, Fidus exited its Vertex Enterprises debt.
Yeah, that was a rough one.
They exited for a mere $200,000, cementing an aggregate realized loss of $11.0 million.
Now, to be fair, that was previously written down in previous quarters.
Sure, but recovering $200K on an $11 million loan, that shatters the illusion that first lien positioning makes you bulletproof.
It proves that when these smaller companies fail, they can fail spectacularly.
Total wipeout. But Fidus is trying to manage their cost of capital to defend against this. They just issued $7.5 million in SBA debentures at a fixed 4.746% rate.
Which is brilliant to maintain liquidity. Locking in fixed liabilities while holding floating assets helps protect their spread.
But the real defense, the thing income investors care about, is the buffer. Fidus is sitting on $38.0 million of estimated spillover income.
Retained earnings from past quarters.
Exactly, which translates to a full $1.00 per share. I mean, it's basically a massive rainy day fund for retail dividend investors.
It really is.
So if falling rates compress their yields, is this 1.0 per share buffer enough to guarantee that 50-cent quarterly payout for you over the next year?
It's exactly why retail investors flock to Fidus. I mean, that dollar covers a full 2 quarters of dividends.
A huge cushion.
Yeah, it provides a massive shock absorber against rate cuts or sudden loan defaults. It makes the current 9.8% dividend yield highly secure in the near term.
Which leaves us with a really fascinating macro question to ponder. You look at Fidus generating a 12.5% yield and seeing 6% EBITDA growth in its portfolio.
While traditional banks are running scared and tightening lending standards.
Exactly. It raises the question for you to mull over. Is the lower middle market private credit sector actually a safer harbor right now than traditional corporate debt?
With that kind of structural protection, it just might be.
It's definitely something to watch. All right, that's it for this deep dive. Make sure you hit follow on the show for daily, no-fluff earnings coverage and deep dives into the financial markets. We'll catch you next time.